Okay, welcome back, fellow CFA Level 1 program curriculum students. Reading 43, Financial Technology and Investment Management, Fintech in Investment Management. Learning outcomes, the candidate should be able to describe fintech, describe big data, artificial intelligence, and market machine learning, describe fintech applications in investment management, describe financial applications of this distributed ledger technology. Obviously, this is very quite an emerging sector, and then it's an important section in the financial world about technology and introduction. The meeting of finance and technology, commonly known as fintech, is changing the landscape of investment management. Achievements include the use of big data, artificial intelligence, and machine learning to evaluate investment opportunities, optimize portfolios, and mitigate risks. These developments are affecting not only quantitative asset managers, but also fundamental asset managers who make use of these tools and technologies to engage in hybrid forms of investment decision-making, investment advisory services, and undergoing changes with the growth of automated wealth advisor or robo-advisors. Robo-advisors may assist investors without the intervention of human advisors, or they may be used in a combination with human advisors. The desired outcome is the ability to provide tailored, actionable advice to investors with greater ease of access at a lower cost. In the area of financial record keeping, blockchains and distributed ledger technology, or DLT, are creating new ways to record, track, and store transactions for financial assets. As an early example of this trend is the cryptocurrency Bitcoin. But the technology is being considered in a broader set of applications. This reading is divided into 7 main sections, which together define fintech and outline some of the key areas and impacts in the field of investment management. Section 2 explains the concept and area of fintech. Section 3 and 4 discuss big data, artificial intelligence, machine learning. Section 5 discusses data science, and Section 6 provides application to fintech and investment management. Section 7 examines DLT. A summary of key points completes the reading. What is fintech in its broadest sense? The term fintech generally refers to technology-driven innovation occurring in the financial service industry. For the purposes of this reading, fintech refers to technological innovations in the design and delivery of financial services and products. Note, however, that in common usage, fintech can also refer to companies, often new startup companies involved in developing the new technologies and their applications, as well as the business sector that comprises such companies. Many of these innovations are challenging the traditional business model of incumbent financial service providers. Early forms of fintech include data processing and automation of routine tasks, then followed systems and provided executions of decisions according to the specific rules and instructions. Fintech has since advanced into decision-making applications based on complex machine learning logic, where computer programs are able to learn how to complete tasks over time. In some applications, advanced computer systems are performing tasks at levels far surpassing human capabilities. Fintech has changed the financial service industry in many ways, giving rise to new systems for investment advice, financial planning, business lending, and payments. Whereas fintech covers a broad range of services and applications, areas of fintech development that are more directly relevant to the investment industry includes the following: analysis of large data sets, in addition to growing amounts of traditional data such as security prices, corporate finance statements, economic indicators, massive amounts of alternative data generated for non-traditional data sources such as social media and sensor networks can now be integrated into a portfolio manager's investment decision-making process and used to help generate alpha and reduce losses. Analytical tools for extremely large data sets, techniques involving artificial intelligence, AI computer system compatible for performing tasks that prerequisitely requires human intelligence may be better suited for identify complex nonlinear relationships that traditional quantitative methods and statistical analysis. Advances in AI-based techniques are enabling different data analysis approaches. For example, analysts are turning to artificial intelligence to sort through an enormous amount of data from company filings, annual reports, and earning calls to determine which data are most important, and to help uncover trends and generate insights relating to human sentiment and behavior. Automated trading, execute investment decisions through computer algorithms, or automated trading applications may provide a number of benefits to investors, including more efficient trading, lower transaction costs, anonymity, and greater access to market liquidity. Automated device robo-advisors, or automated personal wealth management service providers, investment services to larger numbers services to a larger number of retail investors at lower cost than traditional advisor models can provide financial record keeping. New technology such as DLT may provide secure ways to track ownership of financial assets on a peer-to-peer basis by allowing P2P or peer-to-peer interactions in which individuals or firms transact directly with each other without the mediation of a third party. DLT reduces the need for financial intermediaries. Drivers underlying fintech developments in these areas include extremely rapid growth in data, including their quantity, types, sources, and quality. The technological advances that enables the capture and extraction of information from them. The data explosion is addressed in Section 3, and selected technological advances and data science are addressed in Section 4 and 5 respectively. Big data, as noted, data sets are growing rapidly in terms of size and diversity of data types and are available for analysis. The term big data has been used since the late 1990s and referred to a vast amount of data being generated by industry, governments, and individuals. The electronic device, big data includes data generated from traditional sources such as stock exchanges, companies, and governments, as well as non-traditional data sources known as alternative data arising from electronic devices, social media, sensor networks, and company exhausts. Traditional data sources includes corporate data in the form of annual reports, regulatory filings, sales and earnings figures, and conference calls with analysts. Traditional data also includes data that are generated in the financial markets, including trade price volumes. Because the world has become increasingly connected, we can now obtain data from a wide range of devices, including smartphones, cameras, microphones, radio frequency identifications, readers, wireless sensors, and satellites that are now in use all over the world. As the internet and the presence of such network devices have grown, the use of non-traditional data sources or alternative data sources, including social media, email, and alternative data sources, email and text communication, web services, online news sites, and other electronic information sources has risen. The term big data typically refers to data sets having to follow characteristics of volume, velocity, and variety. Feature related to big data. Data? Did you say data or data? I say data. Volumes, velocity, variety is shown in Exhibit A. Mega, giga, tera, peta. Exhibit 1 shows that data volumes are growing from megabytes to gigabytes, to terabytes to petabytes. As for more data are being generated, captured, and stored. At the same time, more data, traditional and non-traditional, are available to real-time or near real-time basis for far greater variety of data types than ever before. Big data may be structured, semi-structured, or unstructured data. Structured data items can be organized in tables and are commonly stored in databases, with each field represents the same type of information. Unstructured data may be disparate, unorganized data that cannot be represented in tubular form. Unstructured data, such as those generated by social media, email, text messages, voice recording, pictures, blogs, scanners, and sensors, often requires different specialized applications for custom programs before they can be useful to investment professionals. For example, in order to analyze data contained in emails or texts, especially developed for customized computer codes, may be required to first process these files. Semi-structured data may have attributes of both structured and unstructured data. Sources of big data. Big data therefore encompasses data generated by financial markets, businesses, governments, individuals, sensors, the Internet of Things, or IoT. In gathering business intelligence, historically, analysts have tended to draw on traditional data sources, employ statistical methods to measure performance, predict future growth, and analyze a sector and market trends. In contrasting analysis of big data corporations, the use of alternative data sources for retail sales data to social media sentiment to satellite imagery that may reveal information about agriculture, shipping, and oil rigs. Alternative data sets may provide additional insights about consumer behaviors, firm performance, trends, and other factors important for investment-related services, such as information is having a significant effect on the way that professional investors, particularly quantitative investors, approach financial analysis and decision-making processes. There are three main sources of alternative data: data generated by individuals, data generated by business processes, and data generated by sensors. Data generated by individuals are often produced in text, video, photo, or audio formats and may be generated through such means as website clicks and times spent on a website. This type of data trend tends to be unstructured. The volume of this data is growing dramatically as people partake in greater numbers and more frequently in online activities such as social media and e-commerce, including online reviews and products, services, and entire companies as they make personal data available through web searches, emails, and other electronic trails. Business process data includes information flows from corporations and other public entities. These data tends to be unstructured data and includes direct sell information, such as credit card data, as well as corporate exhaust. Corporate exhaust includes corporate supply chains information, banking records, retail point to sell scanner data. Business process data can be leading or real-time indicators of business performance, whereas traditional corporate metrics can may be reported only on quarterly or even yearly basis, are typically lagging indicators of performance. Sensor data are collected from such devices as smartphones, cameras, RFID chips, and satellites that are usually connected to computers through wireless networks. Sensor data can be unstructured, and a volume of data in many orders of magnitude greater than that of individual business process data streams. This form of data is growing exponentially because misprocessors and network technology are increasing presence in a wide array of personal and commercial electronic devices extended to office buildings, homes, vehicles, and many other physical forms. This accumulates in a network arrangement known as the Internet of Things that is formed by the vast array of physical devices, home appliances, smart buildings, vehicles, and other items that are embedded with electronic sensors, softwares, and network connections that enables the object in the system to interact and share information. Exhibit 2 shows the classification of alternative data sources that includes examples for each. So here's exhibit 2. The search to identify new factors that may affect the security prices, enhance asset selection, and improve trade executions, and uncover trends. Alternative data are being used to support data-driven investment models and decisions. And interest in alternative data has risen. That has been a growth in the number of specialized firms that collects, aggregates, and sells alternative data sets, while the marketplace for alternative data is expanding. Investment professionals should understand potential legal and ethical issues relating to the information that is not in the public domain. For example, the scraping of web data could potentially capture personal information that is protected by regulators, or that may be published or provided without explicit knowledge and consent of the individual involved. Best practice are still in development in many jurisdictions, and because the varying approach taken by national regulators, there may be conflicting forms of guidance. Big data challenges. Big data poses several challenges with the use of investment analysis, including the quality, volume, and appropriateness of the data. Key issues revolve around the following questions, among others. Does the data have selection bias, missing data, or data outliers? Is the volume of collected data sufficient? Is the data set well suited for the types of analysis? In most instances, the data must be sourced, cleansed and organized before analysis can occur. The process can be extremely difficult, with alternative data owning to the unstructured characteristics of the data involved, which are more often qualitative than quantitative of nature. Given the size and complexity of alternative data sets, traditional analytical methods cannot always be used to interpret and evaluate these data sets. To address this challenge, artificial intelligence and machine learning techniques have emerged that support work on such large scale and complexity sources of information. Advanced analytical tools, artificial intelligence and machine learning, artificial intelligence computer systems are capable of performing tasks that have traditionally required human intelligence. AI technology has enabled the development of computer systems and exhibit cognitive and decision-making ability comparable to superior to that of human beings. An early example of AI was the expert system, a type of computer programming that attempts to stimulate the knowledge-based analytical abilities of human experts in specific problem-solving contexts. This was often accomplished through the use of if-then rules, but in the 1990s, faster networks and more powerful processors enable AI to develop to play in logistics, data mining, financial analysis, and medical diagnosis, and other areas. Since the 1980s, financial institutions have made use of AI, particularly neural networks programming based on how our brain learns to process information. To detect abnormal changes are claims in client and credit card fraud detecting systems. Machine learning (ML) is a technology that has been grown out from a wider AI field. MR machine learning algorithms are computer programs that are able to learn how to complete tasks and improving their performance over time with experience. As it is currently used in the investing context, ML requires massive amounts of data for training. So although some ML techniques have existed for years, sufficient data have historically limited broader applications. Previously, these algorithms lack access to the large amounts of data needed to model relationships successfully. The growth in big data has provided ML algorithms such as neural networks with sufficient data to improve modeling and predictive accuracy, and greater use of ML techniques is now possible. In ML, the computer algorithm is given inputs and maybe given outputs. The algorithm learns from the data provided by best of the models. Inputs and outputs are given. Training occurs as the algorithm identifies relationships in the data and use the information to refine its learning process. ML involves splitting the data set into a training data set and validation data sets. The training data sets allows the algorithm to identify relationships between inputs and outputs based on historical patterns in the data. Relationships that are then tested on the validation data set. Once an algorithm has mastered the training and validation data set, the machine learning model can be used to predict outcomes based on other data sets. Machine learning still requires human judgment in understanding the underlying data and selecting the appropriate techniques for data analysis. Before they can do so, the data must be clean and free of biases and spurious data. As noted, ML models are required sufficiently large amounts of data and may not perform as well. There may not be enough available data to train and validate the model. Analysts must also be cognizant of errors that may arise from overfitting the data, because models that overfit the data may recover false relationships or unsubstantial patterns that will lead to prediction errors and incorrect outputs. To precisely forecast overfitting occurs when the ML model learns the input and target data sets too precisely. In such cases, the model has been overtrained in the data and treat noise in the data as true parameters. And a machine learning model that has been overfitted is not able to accurately predict outcomes using different data sets and may be too complex. When a model has been underfitted, the ML model treats true parameters as they are noise and are not able to recognize relationships within the training data. In such cases, the model may be too simple. Underfitted models will typically fail to fully discover patterns that underlie the data. Types of machine learning. Machine learning approaches can help identify relationships between variables, depict patterns or trends, and create structure for data, including data classifications. The main types of machine learning approaches include supervised and unsupervised learning. In supervised learning, computers learn to model relationships based on labeled training data. In supervised learning, inputs and outputs are labeled or identified for the algorithm. After learning how best to model relationships for a labeled data, the training algorithm are used to model or predict outcomes for a new data sets, trying to identify the best signal or variable to forecast future returns on a stock, or trying to predict whether local stock market performances will be up, down, or flat during the next business day, are problems that may be approached using supervised learning techniques. The unsupervised learning computers are not given label data, but instead are only data from which the algorithm seeks to describe the data and other structure, trying to group companies into peer groups based on their characteristics rather than their standard sector or country grouping, is a problem that may be approached using unsupervised learning techniques. Underlying AI advances have been a key development relating to neural networks and deep learning. Computers and neural networks, often with many hidden layers, to perform multi-stage nonlinear data processing and identify patterns. Deep learning may use supervised or unsupervised machine learning approaches by taking a layered or multi-stage approach to data analysis. Deep learning development and understanding of simple concepts and information informs analysis of more complex concerns. Okay. The ability to analyze big data using machine learning techniques alongside more traditional statistical methods represents a significant development in investment research, supported by the presence of greater data availability and advances in the algorithms themselves. Improvements in computing power and software processing speeds and falling storage costs have further supported this evolution. Machine learning techniques are being used for big data analysis to help predict trends or market events, such as the likelihood of successful mergers and the outcomes of political elections. Image recognition algorithms can now analyze data from satellite images systems to provide intelligence on numbers of customers in retail stores, parking lots, shopping activities, and manufacturing facilities, and yields on agricultural crops, to name just a few examples. Data science, extracting information from big data. Data science can be defined as an interdisciplinary field that harnesses advances in computer science and other disciplines for the purpose of extracting information from big data. Companies rely on expertise of the data scientists or an analyst to extract information on insights from big data for a wide variety of business and investment purposes. Important consideration for data scientists is the structure of the data, as noted in the conclusion of discussion of big data, because their unstructured nature. Alternative data often requires specialized treatment before they can be used for analysis. Selected applications of fintech to investment management. Financial technology is being and used in numerous areas of investment management. Applications for investment management include text analytics and natural language processing, robo-advisory services, risk analysis, and algorithmic trading. Text analytics and natural language processing. Text analytics involves the use of computer programs to analyze and derive meaning, typically from large unstructured text or voice-based data sets, such as company filings, written reports, quarterly earning costs, social media emails, internet postings, and surveys. Text analytics includes using computer programs to perform automated information retrieved from different unrelated sources in order to aid in the decision making process more than analytical. Use include lexical analysis, or the analysis of word frequency in a document, and pattern recognized based on the keywords and phrase. Text analytics may be used to in predictive analysis to help identify indicators of future performance, such as consumer sentiment. Natural language processing, NLP, is the field of research at the intersection of computer science, artificial intelligence, and linguistic that focuses on developing computer programs to analyze interpret human language. Robo-advisory services. Since the emergence of 2008, a number of startup firms as well as large asset managers have introduced robo-advisor services, which provide investment solutions through online platforms, reducing the need for direct interaction with financial advisors. And as robo-advisors have become incorporated into the investment landscape, they have drawn the attention of regulatory activities. In the United States, robo-advisors must be established as a registered investment advisor, and they are regulated by the Financial Conduct Authority. In Australia, financial advisors must obtain an Australian financial service license with guidance on digital robo-advisors tend to start with an investor questionnaire, which may include many of the categories as subcategories shown in Exhibit 4. Exhibit 4 is a synthesis of questionnaires created by the researchers attributed in the sources below. Once assets, liabilities, risk performance, and target investment returns have been diligently entered by the client, the robo-advisor software produces recommendations based on algorithmic rules and historical market data that incorporates the client's stated investment parameters, according to research by Michael Turtilt and Peter Scalds. Robo-advisors do not seem to incorporate the full range of available information into the recommendations. Further research will be necessary over time to see how this may affect performance and evaluation of digital services. Nevertheless, current robo-advisory services include automated asset allocations, trade execution, portfolio optimization, tax loss harvesting, and rebalancing for investor portfolios. Although their analysis and recommendations can cover both active and passive management styles, most robo-advisors follow a passive investment approach. These robo-advisors typically have less fees and low account minimums, implementing their recommendations with low-cost diversified index mutual funds or exchange-traded funds. A diverse range of asset classes can be managed in the manner including stocks, bonds, commodities, futures, real estate. Because of the low cost structure, robo-advisors can reach underserved populations such as mass affluent or mass market segments, which are less available to afford traditional financial advisors. Two types of wealth managers service dominate robo-advisory sector. fully automated digital wealth managers and advisory assisted digital wealth managers. Wealthy and ultra wealthy individuals typically have access to human advisory teams, but there have been a gasp in availability of quality of the advisors to serve investors with less wealth. The advent of robo-advisors offer a cost-effective and easily accessible form of financial guidance, and following a typical passive investment approach, research suggests that robo-advisors tend to offer fairly conservative advice. Excuse me. As the complexity and size of an investor's portfolio grows, robo-advisors may not be able to sufficiently address the particular preference and needs of investors. In the case of extremely affluent investors who may own a greater number of asset types, including alternative assets, in addition to global stocks and bonds, to have greater demands for customization, the need for a team of human advisors, which each with particular areas of investment or wealthy management expertise, is likely to endure. Risk analysis, algorithmic trading. Algorithmic trading is computerized buying and selling of financial instruments in accordance with pre-specified rules and guidance. Algorithmic trading is often used to execute large institutional orders, slicing orders into smaller pieces and executing across different exchanges and trading venues. Algorithmic trading provides investors with many benefits, including speed of execution, anonymity, and revise their execution strategies on the basis of changing prices, volumes, and market volatility. Algorithms may also determine the best way to price the order and most appropriate trading volumes to route for execution. High frequency trading is a form of algorithmic trading that makes use of vast quantities of granular financial data to automatically place trades when certain conditions are met. Trades are executed on ultra high speeds, low latency networks in fractions of seconds. High frequency trading algorithm decides what to buy or sell and where to execute the basis of real-time prices and market conditions. Global financial markets have undergone substantial changes as markets have fragmented into multiple trading destinations consisting of electronic exchanges, alternative trading systems, and so-called dark pools. An average trade size has fallen in this environment, and with market continuously reflecting the real-time information, algorithmic trading have been viewed as an important tool. Distributed ledger technology based on distributed ledger defined below represents a financial technology development that offers potential improvements in the areas of financial record keeping. DTL networks are being considered as an efficient means to create, exchange, and track ownership of financial assets on a peer-to-peer basis. Potential benefits include greater accuracy, transparency, security, and record keeping, faster transfer of ownership, and peer-to-peer interactions. However, the technology is not fully secure, and breaches in privacy and data protection are possible. In addition, the process underlying DLT generally requires massive amounts of energy to verify transaction activity. And now a summary of this chapter. The term fintech refers to technology, innovation, and the design and delivery of financial service and products. Areas of fintech development including analysis of large data sets, analytical techniques, automated trading, automated advice, and financial record keeping. Big data is characterized by three V's: volume, velocity, and variety. It includes both traditional and non-traditional or alternative data sets. Among the main sources of alternative data and data generated by individuals, business processes, and sensors. Artificial intelligence computers systems are capable of performing tasks that traditionally require human intelligence as levels are comparable or superior to those of human beings. Machine learning ML computer programs are able to learn how to complete tasks, improving their performance over time with experience. Main types of ML include supervised and unsupervised learning. Natural language processing is an application of text analytics that uses insights into structures of human language and analyze and interpret text with voice-based data. Robo-advisory services are providing automated advisory services to increasing numbers of retail investors. Service includes asset allocation, portfolio optimization, trade execution, rebalancing, and text strategies. Big data and ML techniques may provide insight into real-time and changing market circumstances to help identify weakening or adverse trends in advance, allowing for improved risk management and investment decision making. Arithmetic trading. Traders use automatic trading programs to determine when, where, and how to trade and order on the basis of pre-specified rules and market conditions. Benefits include speed and execution, lower trading costs, and anonymity. Blockchains and distributed ledger technology DTL may offer a new way to store, record, and track financial assets on a secure, distributed basis. Applications include cryptocurrencies and tokenization. Additionally, DLT may bring efficiencies to post-trade and compliance processing through automation, smart contracts, and identify verifications. And first is wow. We ended that section. That is very interesting. Like all the glossary, there's a lot of terminology that we have to gone over that we have actually gone over in this previous section. Our show notes for the reading program is in the description below. It'll bring you to an Amazon link and you could go get the show notes. I do hope my reading something helpful. I do hope you guys are learning something. If not, you guys could reference the show notes and it will actually help with learning a lot. So our next section is equity and fixed incomes, and obviously that's also going to be another major section. Let me go to that page. Okay, so equity investments is going to be our next section, and I hope to see y'all there. So okay, I'll see you there. Without further ado, good.